This is FinTech Insider News. This week, Vipps launches the world's first Apple Pay rival for iPhone. Goldman Sachs withdraws from the Net Zero Banking Alliance. And Zopa Bank is on the hunt for fintech acquisitions after a £68 million raise. We'll discuss all of these and more on today's show.
If you're in financial services and you're noticing that it's getting harder to acquire and retain customers, you need to know about Finimize. Finimize creates the world's most engaging finance content for retail investors, and you can now white label it for your platform. Get access to a library of over 20,000 news, analysis, and education pieces written by former Wall Street analysts with the retail investor in mind. Not only does the access via API or manual download mean simple, fast integration to your platform, but features like advanced tagging let you easily personalize it to your customers' portfolios and preferences. With content available in over 29 languages, it's never been easier to supercharge your brand with content that resonates globally. Find out how Finimize can grow your brand or elevate your content at finimize.com/business.
Hello and welcome to episode 923 of FinTech Insider. I'm Benjamin Ensor, Director of Research and Strategy at 11FS. I'm joined this week on FinTech Insider News by three great guests who are here to help me break down the biggest stories of the past week in fintech and financial services. First up, a warm welcome back to the pod for Baard Slaattelid, Director of Strategic Payment Partnerships at Vipps MobilePay. It's great to have you on the pod, Baard. You've got some exciting news, which we'll get to shortly. But in the meantime, would you tell our listeners a little bit more about you and a little bit about what you do at Vipps MobilePay, please?
Sure. I'm not sure I'm so interesting, but what I do at Vipps MobilePay is that I manage all our strategic payment partnerships. We are a wallet, not so like everyone else in Europe. We are very in-depth wallet with a lot of payment instruments and accounts available. So that means that we have a lot of touch points with schemes, banks, and acquirers, and sort of anyone who can sort of provide payment services for us or help us provide our payment services to our users. So I manage all of these companies and assets that we sort of need to deliver our payment services to our end users.
Fantastic. Very interesting role. Now we have another FinTech Insider return for Hannah Duncan, who is an award-winning freelance writer. Thank you so much for joining us, Hannah. Welcome back to the show. Can you tell our listeners a little bit about what you write about? Because some people will have come across your articles and some people might not have done.
Hi. Thank you so much for having me back. So I'm a freelance journalist. I used to be working in banking and investment management myself. I write about, honestly, so many different things. Yesterday I was writing about nuclear energy, and the day before I was writing about what type of broccoli we're buying this Christmas. But the thing I'm best known for is usually about sustainable finance and kind of problems in the industry, because I left wealth management because of the problems. And I just was like, I'm going to write about it. So I did. And that's what got me noticed. And that's what's allowed me to carry on being a freelance writer. So yeah, that's it really.
Fantastic. Well, welcome.
Thank you.
And I'm also delighted to welcome Matthew Jones, who is Head of Ventures at Transverse. Welcome to the show, Matthew. Can you also tell our listeners a little bit about you and a little bit about Transverse, please?
Yeah, absolutely. Thank you very much for having me. So Transverse Ventures is a venture firm that is focused on the insurance industry. We are housed within an insurance company, but the money that we invest comes from a range of different industry players and executives. And so what we are is a firm that sits in the middle of that spectrum between financial investing on one side and strategic investing on the other. And what we want to be able to do is use the capabilities that the insurance company has to drive value creation. So thanks very much.
Fantastic. Very, very interesting. Okay, so we have a panel. So let's get on to the news. So our top story this week comes from Norway, which is that Vipps has launched the world's first Apple Pay rival for iPhone. So Norway's Vipps MobilePay has become the first company in the world to offer a competing option to Apple Pay on iPhones. The service, built with Bank Accept and Thales, is already available through Sparebank 1, DNB, and over 40 banks, with more to follow. With Tap with Vipps, users can handle a wide range of transactions, sending money to friends, paying in stores and online, joining customer clubs, and even sending money gifts, all through one app. This is all possible as Apple recently agreed to open its near-field communication, or NFC, chip for contactless payments to third-party providers, following pressure from regulators in the EU and in other markets. Commenting on the launch, Vipps CEO Rune Garborg called it a surreal moment after years of fighting for an equal footing with Apple. So we're lucky enough to be joined by Baard Slaattelid from Vipps on the show today. Baard, if we come to you first, what can you tell our listeners about the launch? This is exciting stuff, right?
Yeah, we think so. I mean, it's the world's first, as far as we know at least, it's the world's first NFC payment wallet on an Apple platform that is not called Apple. So absolutely exciting, and we've been working hard to realize this after we sort of got the news. Now we've been involved with in the Apple case. I think we're the only named entity that has been sort of working alongside, if you want, the EU Commission and the antitrust case, being vocal about our need and want to get access to this technology. This is not technology that Apple invented, so we thought it fair that we would get access to it. So yeah, we launched on Monday. It's with Bank Accept, as you say. It's the Norwegian national scheme. It's a Norway only scheme, so similar to Visa and MasterCard, and it's owned by and delivered to the market by Norwegian banks. So that made it possible for us to sort of create this fast. The technology providers then have different roads to go to the goal, if you want, than if we had to go through the international schemes. So this is so we've launched a Bank Accept Mono solution, enabling our users to tokenize accounts that they already have in our wallet for the payment card that is connected to it under the Norwegian scheme. And yeah, it's going really well. We're sort of we've enrolled now 350,000 users. And we're looking at
and how many people are there in Norway? I mean, I know, but just for our listeners, 350,000 doesn't sound huge, but how many people are there in Norway?
Yeah, we're about 5.5 million people. Our user base is in Norway is 4.6 million, thereabouts. So that means that we're used by everyone. I mean, if you don't have Vipps, then you're either, I'd like to say, too young or too old in a sense. So we enroll users from the age of 6, parental control and under parental guidance, and then obviously if you're on the other end of life, literally, then you can't use us in a sense. So everyone uses us. So we're coming up to about 8-9% of our user base slowly, and we've been peaking at least today with that sort of 200 transactions a minute that is being used. So yeah, we're quite happy with the launch.
Fantastic. Hannah, what do you think of this?
Well, I have a question. What is the difference for consumers? Like, what would they get out of using your version rather than Apple's version?
Well, we are a payment wallet that is sort of dedicated to payments, while Apple is it's a wallet. So among a lot of stuff that Apple does in a sense. So right now, be fair, there's not much difference. It's exactly the same feature. You can activate your card for tapping, and you can tap to pay in a contactless terminal. No difference. But what we can do in future is that we can product develop around the whole financial universe. I mean, we perform 1.2 billion transactions a year. Half of those are P2P transactions. So we are 99.8% of all instant payments in the Norwegian market. We are 25% of all bill payments in the Norwegian markets, and we touch close to 30, 30, a little bit depending on how you calculate it, between 25 and 50% of all e-com transactions in the Norwegian market. So we can connect your in-store shopping experience and transactions with your P2P. For instance, we have launched already as a part of this first initiative is that once you've tapped the transaction or you tap and pay, you can immediately split it among your friends and then just send payment requests. So we can do a lot of stuff that Apple, I'm not saying they can't, but they probably won't because it's not their sort of main area of operation, so to speak.
Baard, I have another question for you. I mean, this has been a long time coming. I mean, I remember, banks complaining about lack of access to the NFC chips, certainly 10 years ago, possibly even 15 years ago. And so my question to you is it almost too late? I mean, because Apple Pay is pretty well established. There's millions of users for Apple Pay around the world. I'm very interested in how are you thinking about trying to persuade people to switch, away from Apple Pay to VIPs?
In Norway, I should say we've been lucky that the Norwegian banks have been sort of holding off on Apple Pay for the most part. Incidentally, they launched support for Apple Pay the day after we launched our solution. So there you go. We can get more than 10 minutes head start. But but no, I think I mean that's a fair question. It's also a fair problem. If you want to win, you have to be better. Now, I would argue that Apple Pay is not very good. It's very simple, but it's not very good. I mean, obviously being simple is also good, but it's not that the Apple Wallet has any, funny features. Now we can do that. Now that means that we create an alternative, and then it's up to the end user and consumer to decide which wallet is right for me. Now I've been using Apple Pay myself for since its inception through my credit cards. But so I know what it's all about. But we truly believe that we can create better user experiences, better entangled user experience with other payment situations from the P2P, so person-to-person payments, e-com payments, and then in-store payments. So yeah, that'll be the. Oh yeah, incidentally, we can also release Tap to Pay for kids because it's account based. So I can then we will probably very soon allow tapping for 6-year-olds if you have a VIPS profile. So that's something that Apple won't do or can't do in a sense, at least not without going really local. And I don't think they will. So yeah. Apple will survive. I think there's room for all kinds of other players to go in and innovate in the space, and we will absolutely have to get up early in order to convince the users to change. But we truly believe we can.
Are you worried Apple are going to come after you?
No.
No? Okay.
Matthew, I'd love to bring you in. Big tech has obviously created, amazing platforms that, all of us sort of take for granted and use on a daily basis. But they're also, at the same time, they can be competitors to financial services companies, insurance companies, and so on. Do you think there's any sort of wider implications from this decision? Do you think there are other areas in which, the regulators maybe need to come in and level the playing field? I don't know. What do you think of this?
That's an interesting question. If I think back a few years ago when I was working for a very, very big reinsurance company, I remember for a period of time, it was about kind of 6, 12, maybe 18 months long. I remember the organization being very, very worried about what is Google going to do in insurance? What is Apple going to do in insurance? And it turned out that none of them actually wanted to be insurance companies, which I know is really shocking. I know we've all got these kind of long-term ambitions to be insurance companies or insurance execs. But it feels a little bit as though that kind of period has kind of passed, and then we're kind of coming back to it now, and we're seeing people begin to experiment again. In terms of the regulatory piece, I think the answer is inevitably yes. It is something that they'll be watching. But I just wanted to kind of pay kind of tribute or credit to the VIPS team. So I saw that I think the ruling kind of on all the kind of design around the regulation was only finalized in July, and here we are in December, and you guys are up and running. So congratulations to the team for the progress and execution against the plan.
the specifications for this was only finalized, as you said, in July. But I mean, as involved in the case, we had some sort of indications of what was coming, obviously pending any agreement. But so we've been looking into it for a while, and this is breaking sort of new ground for us, because we've never been able to compete with NFC or make use of NFC for any payment related stuff. So yeah, this is our team has been working really hard and really fast, also together with our suppliers, SDK vendors, and which is a big French company. So I should probably name them. They're called Thales. They've been doing really well in also sort of changing the way they work, because we're really agile, and we need to bend stuff in order to get there, and yeah, this is it's worked.
Do you think that there's something special about the Nordic culture or market that makes this a particularly interesting place to be launched?
I mean, yes, and I'm not sure how to answer that further without sounding really arrogant, but we're sort of digitally, a couple of years ahead. So digitalization in
ahead
our
of where, Baard? Ahead of where? Just say it. Go on.
Ahead of anywhere. So
okay.
So I mean, one thing, digital EID, we all have it. We've had it for 20 years. So, I mean, just to be able to identify yourself online securely, safely, and, with complete trust is something that sort of creates and enables digitalization in society. So I haven't been to a bank branch, I don't know, 20 years either. I can sign my loan papers digitally online. I don't have to. I mean, if I God forbid lose my job and I need benefits, it's all online. Everything just works. So I helped create what was recently judged to be the best mobile banking solution in Norway. It's not that someone else judged that, but I started that in 2009. That work, and I was head of online and mobile banking at this banking group at the time. Within first half of 2011, it was bigger than online banking. So this is mobile banking 15 years ago. So I mean, yeah, I don't know how to our solution, as I said, we are completely in everyone's pocket. You're financially excluded if you don't use VIPs in Norway. It's the only way grandparents can send gifts to their kids, and I haven't seen cash for same amount of time. So the breeding ground for these type of solutions in the Nordics, I think, is excellent. Actually, PSD2 was probably a step back for us, because we had to go from something that worked to something that didn't work. So this is the sort of the Nordic region in a arrogant nutshell.
I think you're definitely going to start a debate of whether the Nordic countries are indeed ahead of the entire rest of the world. I think there's definitely people in a few other markets in the world who would debate that, but possibly not.
Fair.
People screaming now when they're walking around listening to the podcast.
Yeah, they're not the most modest, are they?
I'll give credit to the UK for regulating payment services, which is something that we actually, in Norway, the financial regulator don't want to talk to us. But I mean, I was in a debate on a conference with the payment service regulator in the UK a few weeks back, and just listening to how the UK actually has taken the regulation of the payment services itself to a dialogue level where you actually speak to the banks and talk about it to get open banking going. I think that's fabulous. So I'm a little bit simplistic in my view, but we have a great sort of starting platform for developing these sort of solutions quickly.
Indeed. Well, congratulations to you and all of your colleagues on this fantastic achievement. Let's move on to our next story, which is that Goldman Sachs has decided to leave the world's top climate alliance for banks. Goldman Sachs has withdrawn from the Net Zero Banking Alliance, which is a coalition of financial institutions committed to aligning their operations with global climate goals. Formed in 2021, the NZBA aimed to unite financial institutions to achieve net zero emissions by 2050 and had over 140 banks signed up worldwide, including Morgan Stanley, Wells Fargo, and until now, Goldman Sachs. Goldman claims it is still committed to hitting carbon reduction targets and that this departure does not mean it's turned its back on the project as a whole. It just wants it to go alone, outside of the NZBA. Its targets are fairly ambitious, a $750 billion commitment to sustainable financing by 2030, of which it has reached 75% earlier this year, supposedly proving its commitment to sustainability. In this light, its withdrawal from the alliance seems paradoxical, given its active role in advancing climate-focused financing. But environmental groups are concerned that this is setting a bad precedent. Hannah, as our resident expert on sustainability and indeed greenwashing, what are your immediate thoughts on this story?
Thank you, Benjamin. Well, okay, so I took a quick look at the numbers. So since joining the Net Zero Banking Alliance in 2021, Goldman Sachs are actually one of the few banks that have been increasing their fossil fuel financing year on year. We don't have the 2024 data, but between 2021 and 2023, they increased it at about 16% each year. So just looking at it quickly, since signing it, they have put $57 billion into expanding fossil fuels, which is a crazy amount. And there's some kind of patterns emerging too, because they were also very supportive at the time of the Paris Agreement. But since the Paris Agreement, they have put $184 billion into expanding fossil fuels, which is it's a really hard number to fathom, actually. I'm from Wales. The GDP of Wales is about 85 billion. So it's like every single penny that we make in Wales over 2 and a bit years, just to expanding fossil fuels. That's Goldman Sachs since signing these things, which I think is it's honestly quite unbelievable. So the areas that they're very into, they're especially into deep underwater oil and gas drilling and exploration. They are number 11 in the world for that. They're also number 11 in the world for fracking, that thing that Liz Truss was very into. They're also quite big on coal investments. And overall, in the whole world, they are the 14th biggest fossil fuel financer. So pretty massive. So when they say that they're leaving the Net Zero Banking Alliance, I can totally see why. Because they're not that committed, it seems, or at least what they're saying is very different to what they're doing. So I would say this is one of those rare examples where a bank is not greenwashing. It's pretty much just not going to lie about it anymore. In terms of the alliance in general, if you look at the top fossil fuel financiers in the world, so you mentioned just then Morgan Stanley and Wells Fargo, they're also in it. They're also in the top 10. There's quite a lot of greenwashing going on here, and a lot of them have actually increased their fossil fuel financing. The money that they say they're putting into sustainability, they are pledging to put this amount, but we have to question exactly what it is and why, because a lot of the sustainable investments at the moment are really not that sustainable, or it's a very sketchy definition. So in conclusion, not too impressed, but also at least they're not lying anymore. What do you guys think?
I want to bring Matthew in because it seems to me that the insurance company over the last 5 years, certainly the last 10 years, has really woken up to the impact of climate change because, 15, 20 years ago, insurance companies were investing in whatever. And now they realize, oh my goodness, that we're suffering catastrophic losses caused by climate change. How unhelpful is it when large banks stop supporting sort of net zero goals? What do you think the insurance industry is thinking about a bank like Goldman Sachs pulling out?
Yeah, so you certainly will struggle to find climate change skeptics in the insurance industry, at least on the property insurance side of things. They can see it. They see it in the numbers. And it's so funny when you see it in the numbers, then the kind of belief follows. So there's a really interesting kind of parallel here on the insurance side. So listeners may have heard of something called the Net Zero Insurance Alliance, which was also kind of another organization that was established. It was chaired by Mark Carney. And through 2023, there was an exodus of members, starting with, I think, Allianz and SCOR. And in fact, the alliance was discontinued in April this year after one by one, the biggest players in the industry started to withdraw. So when I kind of dug into this topic back when I started seeing all of these folks kind of leaving, there are a couple of kind of interesting quotes. So first of all, John Neal, who is the CEO of Lloyd's, the insurance exchange, the insurance marketplace, said at the time that the membership rules needed to be less prescriptive. Didn't go into more detail than that, but needed to be less prescriptive. Otherwise, it would fall apart. And then it did. So John Neal was right about that. But in the year before, there were 23 state attorneys general who had got in touch with the members of the NZIA and said that the targets and requirements were actually in violation of federal and state antitrust rules. And it was essentially that started kind of nudging. It was almost like a domino effect, one after the other. These organizations started to withdrawing. They gave insurers, I think, a month to respond to that kind of threat that they made. But what I thought was really interesting at the time was that I think it was the FT and also Reuters positioned the kind of exodus from NZIA as being a kind of after a US political backlash. And so I wonder if this is an element of, notwithstanding the kind of the data that Hannah shared there, I wonder if this is partly the Donald Trump mood music, as one friend put it the other day. But I wonder if this might be the beginning of the NZBA going the same way as what happened on the insurance side.
Driven by political pressure from Republicans in the States, who include a number of climate change deniers. Sorry, Hannah.
Goldman Sachs are really like a very political bank. So I was also having a look at their lobbying efforts, and just in Europe alone, they've been lobbying in energy transition, renewable energy type initiatives with the European politicians. And then it's a little bit harder to look at US lobbying. But I can see, for example, earlier this year, they made a payment of $30,000 to a Republican on the topic of clean energy. And I think that there's quite a few more times when they've been lobbying against climate change laws, things like that. They're very politically connected, and they're clearly using their power to not save the world, but to make a lot of money. I live in Spain, and earlier this week it was the funeral of the 267 people in Valencia who were drowned to death last month. And when you look at that, it's incredible that banks can really still continue to put profit ahead of their morals. The CEO, David Solomon, he earned more than $31 million last year from being CEO of Goldman Sachs. And yet it's always the same. It's just they follow the money, this short-term profit. And I think it should be very worrying to investors that they clearly there's a lack of morals, but there's also a real lack of being able to follow through on a strategy and seeing the long-term implications of what they're doing. I think it's worrying, and it shows this dire lack of leadership.
Baard, I'd love to bring you in for a Norwegian perspective on this, because Norway's an interesting and slightly paradoxical country, because you're on the one hand a sort of world leader in many areas of sort of renewable energy and so on, and yet on the other hand, Norway, like the UK and other countries, produces oil. How are Norwegians sort of trying to reconcile this kind of thing? What did you think of this story?
Well, yeah. I mean, we are a bit of both. Also, when you look at electric car sales in Norway, it's basically there's no fuel cars are sold. So we're sort of taking charge in at least that part of it. So, but we're also producing fuel and a lot of oil. We'd like to think, and I'm not an expert here, but would like to think that we are going to need to produce energy also from fossil fuels for a good while yet. And then who to do it? Who do you want to do it? Do you want it to be responsible development and have companies that are operating under responsible rules and regulations, as Hannah's been alluding to? I mean, American companies. I think I'd prefer Norwegian companies to do it, being quite heavily regulated and under control, and also contributing to the the shift into greener energies in a larger way. I mean, the Norwegian Statoil, they were called. They changed their name to Equinor because they didn't want to be connected to the oil industry, and also because they were moving into other energy sectors that are greener. But I'm not sure if I'm qualified to have an opinion, but we feel the effect of climate change. I mean, we're a northern country where we're heavily dependent on the Gulf Stream and what it brings to our ports and fjords of water, making sure that we don't freeze to death. So if this all changes, then yeah. So in Norway, it's very the green shift is very important, and sustainability is very important. So. But it is also, we need to combine it with a sort of safe and safe development of an industry, or turning it off safely, I guess. I mean, if we're going to stop doing this, we have to do it in a sustainable way. And also the competence in these sectors is also the same competence that's going to take us into the next green phase, if you want, for lack of a better word. Energy producing or energy producers today and the fossil fuel energy will be the same people that will have to make this shift.
Hannah, can I give the last word on this story to you, sort of 30 seconds? There'll be people listening to this who are very concerned, people in fintech. Is there anything practical you think people in the fintech industry can do about decisions like this one of Goldman Sachs?
Yeah, all the information that I just read to you, it came from a document called Banking on Climate Chaos. And all you need to do is just go on that document, find your bank and see where they are in the world, and make your decision if you want to partner with them or bank with them based on that. Banking on Climate Chaos is really easy.
Thank you. Okay, well, on that note, we're just going to take a quick pause here and we will be back very shortly.
This episode is brought to you by Amazon Prime. There's nothing sweeter than baking cookies during the holidays. With Prime, I get all my ingredients delivered right to my door, fast and free, no last-minute store trips needed. And of course, I blast my favorite holiday playlist on Amazon Music. It's the ultimate soundtrack for creating unforgettable memories. From streaming to shopping, it's on Prime. Visit Amazon.com/Prime to get more out of whatever you're into.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing Trust Center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
Before we get back into the news, we wanted to tell you about our latest Insights show. In a special exclusive interview, David Barton Grimley sits down with Laurie Schwartz, who took on the role of Global Head of Treasury Services at JP Morgan Payments at the start of 2024. They discuss the innovation happening in the Treasury Services and Payments area and how to be innovative in a huge organisation such as JP Morgan more generally. It's a really interesting discussion. To tune in, just head to the podcast below this one in your feed. Right, back to the news. So our next story is that Zopa Bank in the UK is hunting for fintech acquisitions after a £68 million fundraise. Zopa Bank, which was one of the UK's earliest fintechs, has announced that it has recently raised £68 million in an equity round and plans to spend the cash on new acquisitions. Its chief executive said it wants to grow its balance sheet in 2025 by 30% and have 5 million customers by 2028. It already has $3 billion in loans and more than $5 billion in deposits on its books. It is looking at acquisitions of other fintechs after its successful purchase of DivideBuy last year. But Zopa's chief executive says it probably won't look in the consumer credit area, preferring to look at solutions that give it more options for new revenue streams. To find out more about this, we spoke to Zopa Bank's Chief Financial Officer, Steve Hume.
I'm delighted to share that Zopa Bank's raised 80 million in a new equity funding round led by AP Moller Holding, one of the largest direct investors in Denmark. We'll use this funding to support our continuous growth as we prepare to launch a flagship current account and a pioneering Gen AI proposition in 2025. The fundraise really validates our financial performance and growth potential, and it's a real testament to our success over the past year. And in 2024, those successes include reaching 1.3 million customers, 5 billion in customer savings, and over 3 billion in loan balances. And in 2024, we also partnered with household names like John Lewis and Octopus Energy to offer lending to many more consumers. And we'll continue to help customers improve their financial health, gain access to better price credit, and access market-leading savings products. The team's really excited to deliver even more value in 2025 and beyond, so look out for lots more from Zopa.
Matthew, I'd love to bring you in first on this one. What do you think of this strategy? Is acquisition a sort of good way to go to try and sort of diversify the revenues of the business and create more balance across the business as a whole? What's your take on this?
Yeah. So I think the short answer to that question is it certainly can be if it's executed well. My first impression was it's not a lot of money. Now, I know that sounds like a crazy thing to say, but it's not in the context of kind of financial services M&A. So I think that the team must have a really clear sense of what they want to do with it. And I would imagine they've probably got some targets in mind. My first thought when I saw the headline on this is that there are a lot of fintech investors out there probably going to be licking their lips that they're going to be achieving a few exits of companies that maybe haven't quite got to enormous scale over the last few years. So it could be a really, really smart way to accelerate progress towards, some product launches, diversifying those revenue streams, as you mentioned. If those IPO rumors are true, I think people are going to have to move quickly. I don't think they're going to want a whole bunch of loose ends out there as they're going to market, trying to list. So we'll see how that plays out. But I think it certainly could be a very smart way of kind of bolting on some companies to the business.
Baard, I'd love your view on the challenges of acquisitions. I understand you've been involved in a couple of acquisitions yourself. How easy is it to bring together two different companies, two different tech stacks? From the outside, to me, it always looks like it's pretty tricky. Are there any things that help make an acquisition easier?
No, I don't think there's. I don't think so. In our case, we merged the Vipps company, Norwegian company, with MobilePay of Denmark and Finland. We merged a company that was owned by all Norwegian banks with a company that was owned by one Danish bank. We created a single platform. We did that in a little less than a year. So basically making sure that the whole sort of Vipps MobilePay platform is now rolled out in the Nordics. And we also launched in Sweden also. No participants there, but we launched our platform there. So the problem, I guess, or the challenge, I should say, is that, you're bringing together cultures, and even though we're in the Nordics, you probably look at us the same. We're not. We have sort of differences that can sometimes feel very substantial as well. But so there's a whole culture thing. There's a whole technology, as you say, the stack up of technology. How do you? I mean, there's history and there's love that's been gone into creating something that has to give in a sense. So these are challenges. That said, though, they should be overcomable in a sense. But the need, I mean, the speed of companies being established, Europe at least, which is my sort of home domain, I should say, and then payments where I operate, it's not sustainable either. So there has to be mergers and acquisitions, and there has to be some sort of bringing this one step further up the pyramid, so to speak, getting interoperability, or making sure that our solution that I use in the Nordics, I can send money to Hannah in Spain. If that's not the future, then we're going the wrong way in this sense. So this strategy of building on others' success or technology, I think that's the sensible way to go. But yeah, it's challenging.
I would like that. Please send me money. That sounds great.
Yeah, I'll have a talk with Bizum about it.
That's a really interesting perspective. Matthew, I want to come back to you because you mentioned IPOs, and there's sort of rumors of, as you said, about sort of Zopa potentially doing an IPO, and it is very topical because of the chief executive of Revolut saying it wouldn't be rational to float in London. Now, Zopa is one of the oldest UK fintechs. Do you think we could see a Zopa floating on the London Stock Exchange at some point, or do you think that's an unlikely scenario?
Well, as an investor, as a member of the ecosystem, the broader fintech ecosystem in London, I would love to see that. I would love to see more companies going public in London. I spend a lot of my time on the US market, and I think people over there, they kind of look down on the London market with a little bit of pity, like, oh, poor thing. The question I have for the kind of broader market, and whoever might be listening that can help with this, is who is the figurehead that is helping to solve this question of the London listing in London? Who is banging the drum out there? Who is the person that has got this at the top of their priority list? I don't see it right now. I don't see it being a top priority for the government. It needs to come from business. So who is going to lead on that topic and help us to resolve this problem? Because for as long as people don't want to list in London, they will just go to the US, they'll go elsewhere, and this kind of drain of companies and dynamism in the London market will just become an even bigger problem.
Yes, it's becoming a real weakness, not just for the British economy, but arguably for sort of Europe as a whole, that European companies increasingly are looking to, not just in North America, the United States specifically, for capital. And as you say, the headquarters start to migrate, and then jobs start to migrate, and so on. Well, let's hope that Zopa might be the company to start bucking that trend. Okay, let's move on to our next story, which is another UK story, which is that Direct Line, which is one of the best-known brands in insurance in the UK, has accepted a £3.6 billion takeover offer after its rival insurer Aviva raised its bid. So Aviva, which is the UK's largest insurer, has now reached a preliminary agreement to acquire its rival Direct Line for £3.6 billion. After two rejected offers, Aviva raised its bid to 275 pence per share, a deal which Direct Line's board is now recommending to its shareholders. The merger would create a relative giant, controlling more than 20% of the motor insurance market and 15% of the home insurance market in the UK. So the deal is expected to face some scrutiny from the UK competition watchdog and from the Bank of England's insurance regulators. Matthew, it'd be logical to start with you. Is this a good thing for customers, perhaps? Is this an overdue sort of merger within the insurance industry, or is this fundamentally sort of anti-competitive?
So full disclosure to start with, I think most people look forward to the next season of Succession or the next season of Curb Your Enthusiasm. I live for insurance M&A stories. So I loved this story and loved following it over the summer and as it came to a conclusion with Aviva. So I guess to answer your question, I benefit because I get some entertainment as this is playing out. So I think because of the size of the brands that we're talking about here, it probably gets a little bit distorted in people's minds. So, people think that they have, huge shares of the insurance market, and both companies are separately, at least, kind of reasonably, sizable players on their own, but kind of, talking about 10 to 15% of the market. The car insurance market in the UK is one of the most competitive in the world. And if you speak to insurance executives in other markets, they wince when you talk about the ruthlessness of the UK market. My read on this is that over time, consumers will benefit because other firms will be chomping at the bit to take market share off this kind of newly combined firm. Inflation in the car insurance market has been really tough, right? Underlying inflation in kind of the cost to administer claims, parts, car prices has been through the roof over the last couple of years. Fundamentally, these are two companies that are operating at pretty similar levels. If you look at Trustpilot reviews, for example, of both of these, 4.1 out of 5 for Aviva, 4.0 for Direct Line, which has gives Aviva a score of 74%. Direct Line has a score of 78%. So this is a kind of combination of two companies, as I said, that seem to be operating at similar levels. And I think I could be completely wrong about this, but based on everything I've kind of read and pieced together, I think it feels at this stage unlikely that the regulator will step in to say that this can't happen.
Hannah, do you think customers care about whether who their insurance company is? Because I started this by saying, hey, is this bad for customers? But actually, do customers care? I mean, is your insurance company starting to become a bit like your sort of mobile phone provider? You kind of start to forget who you actually get your insurance or your phone contract from.
It depends on the person totally, doesn't it? Like, I care because I care about like what my insurance company is investing in. I care about like where they're putting their money, and I care about the planet a lot. So yeah, I care. But I don't know. I honestly don't know. Like, something I have noticed about Aviva though, I was going to say this, is like Aviva is sort of, it's snatching up a lot of different markets and a lot of different spaces right now. And I noticed this when my SIP, which is with Wealthify, was the same as my workplace pension, which is like Aviva. And we're not even talking insurance. And I think my insurance is actually Aviva too. And then I was applying for these journalism awards the other day, and they were Aviva's Sustainable Journalism Awards, and I was like, oh God, I didn't get shortlisted. And then I went to this talk about carbon credits, and Aviva's buying up all these like wetlands around Britain because they're going to start selling carbon credits. And I'm like, mate, what is Aviva not in? Aviva has got its fingers in every single pie going. So I'm not even surprised that Aviva's doing another acquisition. When is it not doing an acquisition? And is Aviva just going to like take over the world? That's my question.
Baard, did you have any thoughts on this story?
On the British insurance sector? No.
Yeah, I realise it's not your. Okay, Matthew. Direct Line used to have a lot of swagger, right? There used to be the sort of advertising from Direct Line. It was very in your face and so on. Had Direct Line sort of lost its way? This is not where Direct Line would have wanted to end up, being acquired by another company. Did they lose their way?
I think yes is the short version. And by appointing Adam Winslow, I think it was in March this year, it looked as though the organization had kind of turned a corner. Now, listeners may know that Adam Winslow used to be an executive at Aviva, and he is understood to be a very accomplished and competent executive. And if you look at the results that they posted recently, the Direct Line combined ratio dropped about 10.6 points in the first half of 2024 compared to the first half of 2023. So this was an organization that was moving in the right direction. Now, after Adam came in, there was a strategy review. They published the results of that review. And I think the market reaction was a little bit like, is this ambitious enough? So they wanted to cut 550 jobs. It was a very cost-focused project that he was kind of getting underway. But arguably that was necessary to provide the kind of organization with the kind of solid foundation for more kind of innovative kind of or expansionary type activity. So I guess, Adam's now got the choice of whether he's going to polish up his CV or whether he's going to go back to Aviva. Reading the press stories, it's particularly interesting because the press reported him as pleading with shareholders not to take the deal. And the press also reported that he and Amanda have a bit of a tense relationship. Although I did see that if the deal ultimately does go through, Adam will pick up just over £1 million in cash and just over £1 million in Aviva shares, which I don't know about you guys, but would kind of soften the blow for me if I had to go and find a new job. And ultimately, it was a massive premium on the valuation, 73.3% premium to where Direct Line had been trading a few weeks prior. And so, I think the lesson here might be don't bet against Amanda Blanc, who seems to, if she sets her sights on something, she will go and get it by the looks of things.
So he's done well for Aviva's shareholders. He's done well for himself. But some of the direct line employees are probably going to suffer. And, if 500 were on the line for losing their roles, probably others will follow as Aviva and direct line look to cut costs.
Yeah, the bid will have been predicated on assumptions around synergies. So one bank, I think it was KBW, estimated that, in fact, Aviva could have gone up to 300 pence a share, considering their view of how much could be saved by integrating the companies. Jefferies, I think, estimated that £200 million could be taken out. If you look at the kind of maps of the offices of the organizations, there isn't much overlap, to be honest with you. There's overlap in places like Manchester, Birmingham, Bristol, but Direct Line are otherwise kind of based in Bromley, Leeds, Farnham, and Aviva is well known for being in York and Norwich. So there's going to have to be, in order to achieve those kind of cost savings, there's going to have to be a lot of work that's done. And so we'll see what they have in mind when it comes to that.
Matthew, you know so much about this.
I don't get out much. The other interesting thing I found out recently is that General Accident, which is one of Aviva's brands, actually was the first UK insurer to introduce a no claims bonus for homeowners. That was where it started in the market. So when everyone fills in that form to get their insurance next year, everyone will remember that's where it started.
I can imagine you writing a book about the history of insurance that no one will read.
Brutal.
Thanks. Yeah, well, there are a few. Harsh, but maybe fair. There are a few of these history books on the shelf behind me, but at least one person read them because it was me. So
I'm a big. Don't get me wrong. I'm a big fan of insurance. I think the history of corporations is not generally something that is full of interesting lessons. Okay. Well, we are going to move on to have a quick look at one more news story that we don't have time to cover in full, which is that Vanguard is revamping a $900 billion unit to speed up investment. So Vanguard is spinning off its $900 billion wealth and advice segment into a standalone unit. It says the move is designed to streamline operations, enhance investment decision-making, and meet growing client demand. The restructuring aligns with the vision of Vanguard's new chief executive, Salim Ranji, who has emphasized agility and customer focus. As the world's second largest money manager, the article suggests Vanguard's decision could further shake up the wealth management sector, pushing competitors to adapt and innovate. And Vanguard is certainly a very, very impressive company. It's been hugely successful, one of the pioneers of passive investment management, saving investors around the world, millions and millions in fees. So any Vanguard business unit is always a powerful competitor. So it'll be very interesting to watch how that market develops. Okay, and finally, let's have something a little bit more lighthearted from the world of money. A story from the BBC. I gave my kids £300 to see what they would do with it. So teaching children about money is something every parent wants to do, but where do you even start? That was the question tackled in a recent special episode of Moneybox Live from the BBC. Father of two, Hugh, decided to try a bold experiment with his teenage sons, Hywel and Rupert. He gave them each £300, but with a twist. They had to pitch how they'd grow the money before he handed it over. Hywel, who is 14, dove into a tech resale business. He bought drones, flipped them online, and made a not-to-be-sniffed-at £260 profit in 6 months. His younger brother, Rupert, was more cautious. He invested £100 in Hywel's business and is exploring different currencies to invest in. He's convinced he's the smarter investor because he hasn't spent all his cash yet, unlike his brother who spent his profits on a novelty money gun. What do we make of this then, Hannah? And I suspect I may have pronounced Hywel's name wrong, so please correct me if I got that wrong.
My God, those names are so middle class. Rupert and Hywel. The whole story gives me the middle class creeps. I don't know, have £300 and then invest in tech. I don't know, what a story. Probably not very relatable to a lot of people in the UK right now. I don't know. I think that story was supposed to be heartwarming, but to me, I just found it some people have too much money. When we were like growing up as kids, like I think I had £1. You had whatever your age was, you had that many, like 10p. So if I was 8, I had 80p a week. And then after 15, I just had to get a job. None of this like have £300 from my dad business. Like, what do you guys think?
To be fair, these boys are younger than 15.
But they should be getting £1.40 a week by my count.
Baard, what do you think? Is this an appropriate way or a helpful way to try and teach young people about money?
I wish I could have my kids to do. If I gave them £300, it'd be gone in a second. There's probably a jacket or some shoes or trousers or whatever that my daughters and my son would buy. I think I did an experiment with my son, giving him his weekly allowance. No, sorry, it was a monthly allowance. And the day before he was due to get it, he'd already spent it on new football boots. Because he'd ordered them online, and then he forgot they were also ordered from abroad. So he forgot about the toll that you have. There's the customs fee that you have. So he actually didn't have enough money to actually buy them. So I had to step in. So I've never succeeded with my kids, but I guess this is it's a great experiment to sort of see if they can. But kids, they spend, they don't invest. Is my experience. At least that's my parenting that's failed, at least.
There's this experiment where, like, if you give a kid like a sweetie and you say, don't eat it, I come back in 5 minutes. If you haven't eaten it, I give you another one. All the kids just eat it. They can't like think that far ahead at all.
Yeah. The marshmallow test.
That's the one. That's exactly the one I was talking about. Mm-hmm. Yeah. Do you have a book on that too, Matthew?
It's somewhere behind me. Somewhere in there.
What did you make of this, Matthew? Is this a valiant effort to sort of persuade, to get children to sort of think about money and think about the compound interest and the way you can sort of put your money to good use?
So I think it's a valiant effort, and I think, Hannah, you might have to give them a little bit of a break. I think there's the education levels around personal finance. It's so kind of weak in the UK that I guess this kind of dad has taken things into his own hands, and he's trying to teach them. Some fundamentals of how to manage their money. As a kid that was always looking to kind of devise these little ways of making a little bit of money here and there, and I don't remember any of those schemes paying off particularly well. Maybe I'm just a little bit jealous that these kids actually managed to figure it out, and they did all right. So good for them.
But £300, that's like a shopping. That's like. And like a shopping bill is like 100 and something, right? For a family of 4. And you're going to like, if you want your kids to learn about money, say like, make us dinner every day this week, have £50, right? £300 to go spend on a drone when you're 14. That's crazy. I think like we have such like problems with the wealth gap in the UK, and things like this, they just wind me up to be honest with you.
But I think also it's not a kid problem. I mean, give any adult 300 quid and see what they do with it.
Yeah, that's so true, actually.
That's very true, actually. Yeah.
Today I bought a hat. Yeah.
Was it a £300 hat?
I spent €59 on a hat to match my dress. They were like putting flowers in it for me, so I can't really talk. But it was my money I earned.
You were doing so well at being the conscience for Fintech Insider, and you just got and blown it.
I'll show you my hat though, Slash.
Can we make sure that when this goes out, there's a picture of Hannah with the hat on the cover of the podcast?
I sincerely hope so.
I think we have to get a picture of you with the hat. All right. Well, that wraps up this week's Fintech Insider News. Thank you so much to today's guests. You've been fantastic. Where can people find out a little bit more about you and about your companies? Baard, let's start with you. Where can people find out a bit more about you and about Vipps MobilePay?
Yeah, I mean, to me, it's connect on LinkedIn if you're interested in exploring any Vipps MobilePay relations. I am, after all, looking for partnerships, and VippsMobilePay.com is the address.
Thank you. And Hannah, where can people find out a little bit more about you and read some of your many articles?
Same basically on LinkedIn is probably the best way. I'm more of a ghostwriter, so you probably will read my articles without knowing it's me. You'll probably see some middle-aged man in finance and think it's him, but it's not. It's me. I have a website as well, www.hdinvestmentcontent.com. I know the name is too long, so probably LinkedIn is best, Hannah Duncan.
Do you hide any little sort of gifts in your ghostwritten articles? Is there a sort of little way of telling that it's by you?
So many, if you see like the CEO of a bank suddenly quite passionate about like carbon emissions, but like there's a good chance it's me, or whatever my like environment is. Like if I'm drinking like a mint tea, I usually like reference like a mint green dollar note or something like that. I always try and link them somehow.
Fantastic. Matthew, where can people find out more about you and about Transverse Ventures?
Yeah, so please take a look at transverseventures.com, where you can find out a little bit more about what we're interested in, some of the companies that we've invested in before, and you can also get in touch. And please do feel free to get in touch with me on LinkedIn as well. My name is Matthew Jones.
And as for me, Benjamin Ensor, you can also find me on LinkedIn, or you can find out what the team at 11FS have been doing by visiting 11fs.com. So thank you all so much for listening. If you've enjoyed what you've heard, please do follow the podcast. If you want to help us make this a better show, please fill out our listener survey, which is now available at 11fs.com/survey. Or if you want to join the conversation more widely, please just look for us on social media, search for 11FS or Fintech Insider, or you can email us at podcasts@11fs.com. Or you can join our new WhatsApp community channel where you can get the inside track on all of our content. Just get involved via the link in the description below. So thank you so much to my three guests, and thank you so much for listening. Goodbye.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing Trust Center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.